Good evening, good morning, good night. For watching this transmission, tis I, Mike Martins. I want to thank my Patreon supporters for supporting me, and everybody else that's on following me on other sites there. BitChute, Subscribestar, get on there. And I'm on BitChute now. It's getting tough to upload videos, but kind of figuring it out as I go. Be patient, guys. Snowball is growing. The snowball is growing. We are growing as a community. I want to thank everybody for basically having my back. Okay, guys, here we go. U.S. credit card interest rates hit the highest level in 25 years as economy slows. Fed eases. So, what is going on? What is going on? If they're raising interest rates on credit cards, why don't they raise interest rates on the banking and the overnight lending and get, the economy's doing well? Just raise interest rates on everything. So this way, not just on credit cards and consumers' debt and student loan debt, actually raise it on where it needs to be raised to actually start bringing normality back to the markets, right? Instead of lowering rates, and then we're going to hit negative interest rate territories. I just did a video on negative interest rate territories, and it's not looking good right now in Danish land. The gap between the banks are being charged to borrow more money, and what they're charging consumers is widening once again. According to the FT, U.S. consumers are paying higher interest rates on credit card balances than they have in 25 years. Mind you, 25 years ago, buying power was higher. So you would pay less for more stuff. Now you pay more for less stuff. So you're paying more for less. If you're paying less for more. No, you're paying more for getting less, yes. The average rate on interest-bearing card accounts stopped at 17% in May, according to the Fed data, the highest in 25 years that the central banks has been making the calculation. Weekly data-based and creditcards.com survey of 100 national card users found the average rate of a 17.8% at the end of July, another multi-decade high. Okay, so that's 17.8%, right? So what they're doing going off is they're trying to use a blended rate. So what happens is there's people that are like avid credit card users. They have some credit cards at 8%, 15%, 19%, 24%, and 30%. 29.9, right? And so what is happening with that is it's crippling a lot of people, because the blended rate, a lot of people don't understand. When you play a blended rate, the benchmark of the total becomes more manageable, but you're paying that on the total balance, so of what you're paying, right? So 17.8%, let's say on a blended rate on 7 credit cards. That's a lot of juice. That's a lot of vig. Credit card rates started rising off their long-term lows as the Fed started raising the benchmark interest rates between late 2015 and the end of last year. But issuers soon outpaced the Fed, and rates continue to rise. As the Fed embarked on its July rate cut, now the spread between Fed funds and the rate that card issues pay to hold deposits is just under 15%. The widest in recent memory. The spread has only been wider once, and that was in the third quarter of 2009. Analysts blamed a couple of factors for this aggressive rise in credit card rates. The first is that the Card Act of 2009 and U.S. law designed to protect consumers from being exploited by credit card companies. Too bad they don't do that for cell phone companies, where people get ripped off left, right by cell phone companies. The law limits the bank's ability to raise interest rates on existing balances. So, since card issuers can't reprice you once they sold you the card, so they have to price more risks, according to John Hedge Jefferson's a broker. So here it is. Interest rates on card have soared in recent years. Let's see if this puppy opens up in full. There it is. So it's pushing 17 points. The golden years was when like just 2000 up to 2005. 2006 went up, rates went up, then went back down. In 2008, 2010 kind of went back up. Then they had another big spending spree here after 2010. And after, it looks like just after 2016, 2017, things started to uptick right here. So that's where you see the difference there in credit card interest rates. APR, guys, just so you know, that's annual percentage rate. Somebody asked me what is interest rate on U.S. credit cards. This is the APR. So that's annual percentage rate at U.S. commercial bank percentages. Okay, another factor, the perks. Card issuers need to bring in more capital to offset the generous perks that they've been awarding loyal customers. Has chronicled headaches at the JPM has endured thanks to extremely popular Sapphire Rewards card. Still, there's reason for cardholders to be optimistic. Two of the biggest credit card lenders cut rates after the July rate cut. Since the crisis, card rates are often set by adding a premium to a fluctuating index. Most often, the prime rate, the lowest rate banks may be available on non-bank customers. The prime rate, in turn, is directly related to the Fed funds rate that is set by the Federal Reserve. So it's that what it's set at, right? Fed fund rate. After the central bank's decision to cut its benchmark last week, both JP Morgan and Citigroup, respectively the number one of the two U.S. banks by loan volume, dropped their prime rates by 0.25%. This will flow through to the rates paid by many cardholders, and least initially, but card rates and prime rates do not move in tandem. Credit card companies have found other tools to bring in cash, like charging annual fees, of course, and don't pay to play. So they add these things onto your credit card, and then you're like, why are they charging me for this thing? You know what I'm saying? Card companies have also found other ways to increase what card customers pay. For example, by using annual fees, foreign transaction fees, and fees on balance transfers, according to Ted Roseman, creditcards.com. I don't think this Fed rate cut is a big gain to consumers with credit card debt. It never is. If you got credit card debt, it doesn't. It does not help you. Their rate is already high, and even if it goes down slightly, very well might end up paying higher fees in arrears. So they're going to lower rates. So they lower rates. Oh, you're going to save a percentage point on your credit card. Okay. So you're paying 18, now you're paying 17. Or you're paying 29.9, you're paying 25, let's say. Right on. Okay, I'm saving a bit of money. Oh, yeah, but then we got to rewrite and reprocess it, blah, blah, blah. They make up all kinds of stuff on unsecured loans, unsecured lines of credit cards, all kinds of ways, all kinds of great tools the bank offers you. Woo! There is a recorded $850 billion U.S. credit card debt outstanding, according to the Fed. That's a record amount in dollar terms. Yeah, 850 billion. Wow. Though it has declined slightly as a percentage of the GDP, with the economic growth starting to slow and wages still largely stagnant, banks are debating whether now is the time to push for more growth in their profitable credit card business and create more balances that can be bundled into securities. So remember with the housing, don't forget. Securities and sold off the bank's balance sheet. Hopefully, those that opt for more high interest rate loans at least understand the risks. Guys, be very careful. Guys, I have this here. Okay, if you're in Canada, there's one for America. There's one for every English-speaking country on the planet. Guys, pay attention to this, please. It's called debt.ca. You could even use this in the States. It doesn't really matter. You put your monthly income here. Let's say my monthly income is 4 large. Okay. And then what you do is you keep adding your thing, okay? You keep adding it. So it's called debt.ca, okay, guys? Then what you want to do, and this is the debt to income ratio calculator, okay? So then you put other income. So let's say spouse's income. Let's say she has to make more because then I'm going to be considered a racist or something. There you go, $4,100. Then a mortgage. Okay, so $2,700. Then what you do is you add your credit cards here, right? So you go to car loan. Let's say they have in Canada car loans are like $400, $500. I know, in the States it's a lot cheaper, but okay. Car insurance. Let's say $122 a month. And no, not for people living in Ontario. That's credit cards. So then let's add $144 for one credit card, and then the other credit card, let's say Home Depot card. So you just keep adding credit cards, right? Home Depot card. let's say it's 89 bucks. You got some roofing or something done on the house, so you're paying monthly for it. And then you say you have a Chase card or something, and you pay $88 a month. Okay, so then you calculate, and then there's your debt ratio. This is a very normal, this is okay. Total income, $8,100 per month. There's your total debts, $3,603, and there's your debt ratio, 44.48%. So if you're in this, this is 44, so you're right here, cause for concern, and 50% or more, it's dangerous. You should make a plan aggressively to pay off your debt. So there it is there. So if you, let's say, now you paid off this credit card and this credit card and that credit card, and you paid off your car, but you got to have car insurance. So you calculate, boom, debt ratio 34.84%, total debts 2,822, total income 8,100, and you put yourself in the 37% mark right here. 36% or less. Sorry, good. Most lenders consider a ratio of 36% or less for a healthy debt load. So go ahead and do this, guys, if you can. It's called Debt to Income Ratio Calculator Canada, debt.ca. But you know what, guys? It doesn't matter if you're in the States. It doesn't really matter, because you just put your gross, not your net pay in here, and it's going to add up the same, your ratio, right? And kind of follow what's going on here. Let me know what your ratio is down below. I think with mine, I don't have a mortgage. Okay, monthly income, let's say $4,000, okay? My wife doesn't work, stay-at-home mom. And then I don't have a rent or mortgage. I do have property tax. So we'll call it property tax, $150 a month. Car insurance is about that. And then I have one more car insurance. 2 car insurances. And I have home insurance, about $100 a month. And then I have property tax per month, blah, blah, blah. Gas miscellaneous. There's a section here for other payments. So we'll put with groceries and stuff. All that stuff's all right. And that puts me at 27.3. And that's for groceries, bills, blah, 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 everything. And that leaves me with, 27.3%. So this is a good indicator to find out, like, if you want your wife to be stay-at-home or your husband to be stay-at-home, use the calculator to see if you're within a good but mind you, these are just passive bills that everybody has to pay already, right? So don't forget to put your cell phone bill, and okay, let's add cell phone and other stuff. So let's put an extra $200 to be conservative. Calculate. I'm at 32, so I'm still on the 36%, and I'm still getting I'm covering my net, so to speak. Let me know what you guys think in the comments below. Credit cards going up. They are sure going up. And what to do? Start paying them down, guys. Start getting rid of them. Start consolidating. Find a consolidation loan. Pay off your debt. Do your research. Find out what to do. Thanks for watching.